Let me show you some of the questions I get in my DM. I am embarrassed to say I panicked at the end of March and sold all my investments and went to cash. Before I knew it, the market was on the rebound. I kept assuming the market would crash again and give me a chance to buy back in, but whenever the market went down, I never thought it was enough of a decline to justify buying back in. Did I ruin everything I've worked for? I don't know what to do now. And Nifty is up 150 points, but why is my portfolio not moving? Have you also faced situations like these? Most people do months of planning before taking an international trip or buying the latest TV so that they get the best price. But they decide on the equity investment without any research, framework, or goal. In today's video, we'll see how investors, especially new investors, should not invest in the stock market using some great examples. And we come up with such financial education videos every week. So do hit the subscribe button if you want to grow your wealth. Number 1, herd mentality. Imagine a scenario. Your friend buys a stock and it goes up 25%. The next day, another friend buys the same stock and it goes up another 20%. What will you do? The stock is making all the right noise in the news. Will you buy this stock? Will you succumb to the FOMO? Take a look at this chart. It plots the number of demat accounts in existence along with how the stock markets have behaved. You will see there is a clear correlation between the number of accounts in existence and how the prices have moved over the years. In fact, they have moved more or less parallelly for the last 2 years. And why has this happened? The simplest answer is herd mentality. People have seen people around them making money by investing in stocks. This and the fear of missing out have gotten more people to open demat account than any other reason. The run-up in the stock market from April 2020 led to a flood of retail money being invested in the stocks. Confident and greedy dreams, fed by herd mentality, often depends on timing. Investors think that if they can get in and get out at the right time, they will make money. But often they don't, and that's when the market falls. And do you know when is this herd mentality most visible? Hot new IPOs. सब यही सोचते हैं कि लिस्टिंग गेन के लिए ले लेते हैं यार, थोड़ा बढ़ेगा फिर बेच देंगे. Let's take the example of Paytm's IPO. This was a classic case of herd mentality investing where the investors overlooked the fundamentals and went for the hype. In its red herring prospectus, Paytm had clearly mentioned that they had faced net losses for the last 3 years and they may not be able to maintain profitability in the coming future. During its IPO, some brokers had also given an underperform rating for 197 Communication, the parent of Paytm, citing that the business model lacked focus and direction. Paytm listed with 9% discount, and investors have lost over 72% since its listing. Number 2, lack of patience. Time is the investor's best friend. Let's assess the 40-year journey of Sensex from 1979 to 2019. If you invest with 5-year time horizon, there is an 8% chance of you losing money. If you invest with 10-year time horizon, there is a 3% chance of you losing money. And if you invest with over a 15-year time horizon, there is a 0% chance of you losing money. Investing takes time to make money. Even Warren Buffett has made more than 90% of his wealth after the age of 50. And what is a great example of patience in stock market investing? The stock of Reliance Industries. If you had purchased the stock of Reliance Industries in June 2009, you would have not made much money till the end of 2016. But since the introduction of Jio in September 2016, the stock has almost returned 500% in around 6 years. If you had acted hastily, you would have sold the stock at a net loss maybe, and would have regretted later for not participating in the enormous bull run the stock has been since the last 6 years. Number 3, investing based on free tips. This is the biggest mistake that new investors make when they start investing in the stock market. They very easily trust any tip they receive from their friends or colleagues or neighbors or on the Telegram channel or from the finance channels on YouTube. If you blindly trust these recommendations, there is a significant chance that you will earn losses on your investment. Fun fact, or a rather sad fact, broker's advice involves a large conflict of interest. The more you trade, the more money the broker will charge from you. essentially saying that they will give you advice that will make you buy and sell at a higher frequency, making them more money.
But you and me, the brokers, we're taking home cold hard cash via commission, mother.
Don't believe in words like guarantee and assured returns by anybody. In stock market, unpredictability and volatility is not the exception but the rule. Number 4, holding on to losses and booking profits early. Suppose you are holding two stocks. The first one is doing great, but the second one is underperforming. What will you do in this situation? For the first stock, you may think कि 15%, 20% तो बढ़ गया है और कितना बढ़ेगा? Let's sell this and make some money, book some profit. And for the second stock, you may think कि let's hold it for some time so that at least it breaks even, so that you at least recover your initial investment. It's not a loss unless you sell that position. However, you need to understand that this is the wrong approach to take in the stock market. Here, you are limiting how much profit you can make because you are selling your winning stock at a mere 8% or a 12% gain. There is a chance that this stock may go up even 30% or 40% or maybe even 4x. However, you can suffer even greater loss because the losing stock is still in your portfolio. If you don't want to lose money in the stock market, your approach should be exactly opposite. You should not sell your winners, but cut the risk and sell your fundamentally weak, non-performing stocks. And what is a great example of this? Yes Bank stocks. At one point in August 2018, the Yes Bank stock was trading at around 360 rupees, and the then MD and CEO Rana Kapoor had vowed to never sell this stock and pass them to his daughters. 4 years later, the story is very different. The stock is currently trading around 14 rupees, down almost 96% from its all-time high of 404 in 2018. There was a lot of negative news surrounding the bank from July 2019 to March 2020, giving the investors a good 9 months period to exit if they wanted. But most of the retail investors did not exit the stock. They thought the bank was too big to fail, and even if there was any problem, RBI would come to its rescue. As a result, by March 2020, retail investors had lost more than 3,300 crore on their investment in Yes Bank. Even a sudden massive crash may give you the opportunity to exit the stock. However, retail investors see a brief uptrend as a sign of recovery and fail to seize this opportunity to exit and minimize their loss. And number 5, speculation and insufficient research. The most recent example of insufficient research is the Ruchi Soya stock, which saw a 9,000% increase in just 6 months. In September 2019, Ruchi Soya was in the RBI's list of major willful defaulters, and it was at the end of a nearly 2-year-long insolvency process. Around that time, it was approved to be acquired by Baba Ramdev's Patanjali Ayurveda for 4,350 crores. A month after the acquisition, the stock was relisted on stock markets in January 2020 and it was trading at around 17 rupees in the market. By the end of February, it was trading 4 times higher at rupees 62. By the end of March, it was trading at 172 rupees. The price was 413 rupees at the end of April and 1535 at the end of June. An astonishing 8,929% increase over its relisting price of 17 rupees. However, this mad frenzy soon paused and the stock fell by 70% in the next 3 months. Usually, when the companies come out of the insolvency process, there is no clear picture of their financial position or the intention of the promoters. No one knows what is going to be the future of such companies, and that's why there's a lot of speculation. So, despite the poor performance, the stock rose by 9,000% and then fell by 70% in the next 3 months. And who gets caught in this quest to make quick money? The retail investors. Any financial expert will tell you that stocks are the key to build wealth in the long term. But the tricky part is they grow in the long term exponentially, but it is very difficult to predict their day-to-day behavior in the short term. So how do you make money with stocks? The answer is simple. With some research. Stock market investing is not rocket science. You can learn this art of finding undervalued stocks that will give you great value over time by practicing, reading, and patience. And the other simpler way is to invest through index funds. So now I hope you have a good understanding of how not to invest in the stock market. And thank you for watching till the end. If you like this video, do press the like button because otherwise YouTube does not show this video to anybody else. Wrapping it up, this Paritosh signing off.